All right, good afternoon. As promised, this is the second part of the aggregate supply, aggregate demand dynamic lecture. One of the key things about the dynamic model, and I've heard this from several students this term, and certainly hear this from students when the class is taken in the normal semester, is that what really seems to be complicating to them, and at times sort of complicates their ability to really like have an answer, a definitive answer to some sort of question. So like, what happens if the government runs deficit spending to boost aggregate demand? What happens if the government raises taxes? What happens if the Fed, targets lower interest rates? And the ISLM aggregate supply, aggregate demand framework, the basic versions are nice because at least the initial policy and or shock that you want to, in a sense, kind of start off your model with, that part's easy. And hopefully at this point, you feel like if I said, hey, okay, in an ISLM scenario, show me what happens if the government cuts taxes, or in an ISLM scenario, what happens if the Fed increases the money supply, right? And then, of course, from the ISLM, that tells you about interest rates and output. And then you can take that to the aggregate supply, aggregate demand framework, because everything works through ISLM into the aggregate demand. It's going to be affecting aggregate demand. And so my hope is that all seems very clear to you. What may not seem clear, and there really wouldn't be a reason for it to be clear at this point, is especially in a world of adaptive expectations about inflation, when you start sort of contemplating, inflation, and especially when you start to contemplate expected inflation as a shifter of aggregate supply. Okay, so let's talk a little bit about that. So let's start, and we're going to sort of focus right now on this point right here, which is that in the dynamic ASAD model, aggregate supply now responds to something. Think back to the sort of classical, neoclassical synthesis, and we really have kind of either a horizontal short-run aggregate supply curve, or we have a completely vertical long-run aggregate supply curve, and then we can sort of like think about the dynamics as we transition from the short run to the long run. But that's very ill-defined. What does the short run mean? What does the long run mean? So on and so forth. In the dynamic ASAD framework, we're going to have a more dedicated, deterministic model, in the sense that now, if, for example, we're going to contemplate government policy, instead of just saying the government cuts taxes, we'll say something like the government cuts taxes for the next 4 time periods, or for the next 2 time periods, or the Fed targets lower interest rates for 1 year or 2 years, whatever the kind of timing of this that we're interested in. And then, depending upon the persistence of the shock, either a policy shock or an exogenous shock, we're going to have a much clearer picture, at least in the context of the model, as to how long, or I tend to think about sort of the ripple effects of these shock policies or otherwise. So the important thing really from this perspective is this point here, that the aggregate supply now responds to expected inflation. And again, remember, we're going to stick with adaptive expectations here, such that expected inflation is just inflation from last period. And the general behavior is going to be that if inflation expectations go up, in other words, if in time period T, I think inflation is going to be higher in time period T plus 1, because remember, right, your expectations about inflation next period are set today. So I have today's expectations about future inflation rates. And if I expect future inflation rate to go up, right, in time period T plus 1, then the idea is that that's going to affect the aggregate supply over that transition to that time period. So in particular, we can think about the aggregate supply curve as being just this curve with respect to a particular level of inflation. And then the key ideas here are the adaptive expectations component and this output gap. And then the other nice thing about the dynamic model is that we do also have these shocks. right? So this is a supply shock. There's going to be a demand shock in the demand model as well. Um, I mentioned to you yesterday the concept of dynamic stochastic general equilibrium models, so-called DSGE models. That's the stochastic idea has a lot to do with these shocks. So the idea is that while sort of we can think about the economy as sort of following a particular trend, that there are going to be these exogenous shocks that essentially are quite random. So, for example, if you go back to COVID was a random shock. There was no expectation that COVID was going to happen, and so that, and from a sort of shock perspective, was very much a surprise and very much would sort of show up in terms of the demand shock as well as a supply shock, right? Because we had the supply shock due to COVID supply disruptions, and then we also had the demand shock caused by the fact that a lot of people weren't going to work on a daily basis. That stochasticness is very important because very often these shocks are where policymakers have a difficult time achieving their various targets. So you can imagine that in this world, we're still in the sort of idea that the Federal Reserve is going to be targeting a particular interest rate, targeting a particular inflation rate, that the federal government is trying to pursue a growth perspective in the context of policy. And then so what policymakers respond to in terms of these shocks ends up being a sort of an outsized effect on actual economic outcomes. So it isn't so much a world of, everything's hunky-dory and then we get bad policy. It is, things are generally okay, but then there could be some bad shock that occurs. And so policymakers, in a sense, need to know how to respond to that particular idea. Okay, so in terms of aggregate supply here, we're going to have some aggregate supply shift. In particular, we want to say that higher potential output. So Y bar here is potential output in time period T. So the idea here is that for any given time period, there is a potential level of output. And again, when we say potential, we mean output at full employment. So basically, there is a full employment at time period T. And so if between time period T and T plus one, there's some reason for there to be a higher level of potential output, for example, maybe we have a positive supply shock. All right, under a positive supply shock, this would increase the level of potential output, and that's going to cause a shift in the aggregate supply curve. Then we have the inflation expectations also becomes a shifter of the aggregate supply curve, and then also, of course, those shocks that we were saying. Now, on the aggregate demand side, it's a fairly simple story as the one we had before, although there's a couple of things to point out. First and foremost, the aggregate demand curve is downward sloping because of, and I think this is sort of a unique thing about this particular model. The aggregate demand curve is downward sloping because our expectation is that the Fed is going to fight inflation with higher interest rates. And so therefore, as inflation falls, interest rates are falling, and therefore we're going to have higher quantity demand in terms of aggregate demand. So the reason why aggregate demand is sloping here is because of the central bank raising interest rates due to concerns over inflation. And then in terms of shifting aggregate demand, expected potential output is also a demand shifter. This is the inflation target. So pi star here is what the Fed is targeting inflation at. That's an important distinction to point out here, is that the aggregate supply responds to inflation expectations, whereas demand responds to inflation target. The reason why that is because the aggregate supply is businesses deciding how much to produce and how much to charge for their product, right? And so in that world, what matters is expectations about future inflation. In the demand side, we're talking about people actually spending money, investments, consumption, the government spending money as well. And in that world, those decisions are going to be based upon the inflation target. And the reason why that's going to be the case is that if, for whatever reason, the Fed decides to target a higher inflation, this is going to cause the aggregate demand to shift out. Because basically, what that would mean is that if the Fed is targeting a higher inflation rate, then they essentially want to allow the output gap to grow. They want output to be greater than potential output, with the idea being that we would potentially move to a new higher level of potential output over time. Is sort of the basic idea there. So, but the key here beyond all of this is that we want to start to also think in terms of time periods. So we want to think in terms of, okay, there's an initial sort of where the economy is, and then there's going to be some shock or some policy. And then depending upon the length of that shock, the length of that particular policy, it's going to tell us as to how the dynamics are ultimately going to work out. Okay, so here we just have equilibrium in the short run. Like the ISLM tradition of the goods and money markets being in equilibrium, but not necessarily at full employment, that's also something that we allow to happen in the dynamic ASAD model. So you can have equilibrium in terms of aggregate supply, aggregate demand here, and that does not necessarily mean that you are at potential output. And so, again, there is still this sort of classical and then a Keynesian reinforced tradition of thinking about potential output as this stock. Basically, the economy has a potential amount of stuff it can make if everything is working the way that it should. And then, as you can see here in this particular graph at point A, for some reason, the economy is not necessarily operating where it should. And then, of course, policymakers are going to try to get the economy to operate at Y bar. And so we now sort of are armed with a set of policies and a set of ways to show those policies that can actually get us to, okay, what is this ultimately going to look like? So again, you want to think in terms of time periods. So the idea here is that you start with a current period level of output and a current period level of inflation. So at point A, that's where the economy is right now. So right now, the economy is producing pi t inflation at an output level of YT. Okay. Now we can see visually that that is below potential output. So in a sense, the economy is in recession. The other term we use for this to describe situations in which output is below potential output, but we wouldn't necessarily consider that to be like a recession. We just refer to that as slack. So if output is less than potential output, could be a recession, or we also just refer to this as slack. The idea behind slack is that, you know, there's the economy is not sort of working completely efficiently. So there's a slack in the economy that's sort of operating at below efficiency. So if we're going to take this argument back to, you know, kind of a chief classical argument, it is that we want the economy always working at efficiency. And so what this graph would suggest is that the economy is currently not efficient. And in particular, it's not efficient because we are not at potential output. Now, taking that a step further, if we are not at potential output, then that in a sense also means that we don't have inflation correct. So in other words, the current level of inflation is not necessarily where we want inflation to be. And in order for us to get the economy where we want it to be, we're going to have to potentially target higher or lower inflation, depending upon where we actually are in terms of the current situation. Okay, so now let's assume for a moment that we can isolate sort of this idea of growth over time. And this will be a nice way to kind of just get some basics of the dynamics. And then we're going to go back and we're going to talk more about, okay, what happens if the economy is currently below output? Let's assume there's some sort of expansionary policy. And then let's see how that works its way through the economic system. So in the dynamic model, one of the sort of different ideas that you sort of get that's distinct from ASAD is that in ASAD, there's not really this over time aggregate supply is growing, right? In fact, in typical ASAD, aggregate supply is static, and you only change it if you say it's changing for a particular reason. In the dynamic model, we expect there to be growth in aggregate supply over time due to natural factors, population growth, the fact that economies accumulate capital, and that will tend to work its way out in the form of incomes, and then, of course, technological progress. Now, go back. We haven't talked about production functions for a while, but they're going to come back. They're going to be a big deal next week when we talk about the solo growth model. And so we're going to think about output at time period t as still being a production function. So we have capital at time period t and then labor at time period t. And so the argument here is that over time, capital is purchased and then accumulates and is used over multiple years. And so we over time tend to get this increase in capital that puts upward pressure on output. And then most countries experience population growth over time that increases labor. And so both of those forces end up putting upward pressure on the production function. And so as a result, when we think about it in the context of the basic sort of production function, you would say for a given level of labor, now the economy is more productive, but then we've also said that labor has increased. So maybe go from labor labor one to labor two. And so not only has the production function increased, but we are in fact now producing at an even higher level that we would have sort of otherwise. And so that's what's going on here in the slide. So there's an increase in output from YT to YT plus 1. And then the important thing to point out here is that now the dynamicness of the model becomes a little bit more seen because, okay, we have this outward shift of potential output. And notice that we're still illustrating potential output as this vertical line. That's not aggregate supply, although we can think about it in terms of it sort of being a long-run aggregate supply. But it's not. It's just potential output. So potential output shifts. Now, if you'll remember, when we talked about AS, something that shifts AS is potential output. Something that shifts AD is potential output. And in this case, both potential output is increasing, and so we're going to get increases in both aggregate demand and aggregate supply. So the increase in potential output causes a shift in aggregate demand. It also causes a shift in aggregate supply. Now, in the model that you see in front of you, what we've done is we've shifted it to the extent that inflation doesn't go anywhere, right? But you can see that if the demand side responds more to the increase in output, if the supply side responds more to the increase in output, that's going to have differential effects on inflation, right? So if the aggregate demand shift is bigger than the aggregate supply shift, we're going to get inflationary pressure. If the aggregate demand shift is less than the aggregate supply shift, then we're going to get deflationary pressure. Why that is important is that if we move beyond that potential output, this is going to cause an output gap at YT plus 1. And what that means essentially is that we will have higher inflation expectations. And then what that's going to do is that's going to cause aggregate supply to potentially shift back. Now, the way that we've shown it here, in a sense, that stops. So we have this boost in potential output, aggregate demand shifts out, aggregate supply shifts out, and we maintain inflation, and the economy is just bigger than it was before. This is the way that we can tend to think about economic growth in this type of model. Next week, when we get to Solo, we'll think about economic growth in a fairly different way. But I think you'll find that a lot of the stuff that we've talked about already carries over. So just the kind of intuition of why increases in potential output cause shifts in both aggregate demand and aggregate supply. Well, firms can produce more. And so firms can produce more at essentially the same cost. So you get that classic supply curve shift. Again, think about representative firms. If there is higher output in the economy, there will be more income in the economy. Therefore, there are more profits to be made in the economy. And so aggregate supply is going to shift out and to the right. And on the demand side, people have more money because incomes are higher because output is higher. So that's why aggregate demand shifts out to the right. And again, there's no change in inflation because the way that we showed it was that the shifts were essentially the same. We don't have to do that, but it makes our life a little bit easier. Now, this is, in some sense, kind of a very straightforward way to think about the dynamic model. Let's now think about it more in terms of shock. So not so much just in terms of growth, but those shocks. And of course, why are the shocks so important to us and the development of the dynamic ASAD? Well, of course, we've talked at length about the 1970s supply shock. Now, I was reading Alan Blinder's a history, monetary and fiscal history of the United States, 1961 through 2021, and there was a really interesting fact that he mentioned in the chapter on the supply shocks of the 1970s that I knew that this was something that had been done, but I did not necessarily realize that economists now believe that if you go back and you look at GDP growth of the United States in the 1970s, you'll notice that in 79 to 80, there is this recession. And the story that I always remember being told about that recession was that recession was a lot to do with expectations about what Volcker was about to do. So, Carter appoints Volcker in 79 when I forgot his name all of a sudden. When he moves to the Treasury, and I think that the sense was that caused people to expect there were going to be very high interest rates because of the signal that Volcker was going to fight inflation. What Blinder mentions in his book, which was a little bit new to me as a concept, was that also Jimmy Carter in 79 pursued credit limits. Basically, one of the things that the president had done is they tried to reduce the amount of consumer credit that was available in the money market. So you can imagine that, consumers had credit cards, and basically what the Carter administration did is they tried to reduce the amount of credit that banks were making to people. And the idea is that this was going to fight inflation because it was going to cause a contraction of the money supply, right? It's a fairly monetarist argument, although I don't think monetarists would necessarily agree that you should have the federal government pursuing credit limits. And this policy was now sort of, we look back on it, it's a complete disaster. It caused a recession. It didn't really do anything to inflation ultimately. And basically shortly after that, we removed the president's ability to be able to do something like that. And no president has ever suggested that we do it again. And so I just thought that was kind of an interesting part of the story, is that it wasn't just the supply shocks. There also was some really bad policy in there from the Carter administration. Okay, so now let's just model a basic supply shock. We'll do this graphically. Okay, so the idea here is, and in particular, we want to say we're going to give the shock a particular time frame. Okay, so basically in time period T, there's going to be an adverse supply shock. Okay, and so from T to T plus 1, that supply shock is going to go away, but there's going to be this adverse supply shock at time period T. Okay, so now if you look graphically, and I'll kind of go through it here to the right on the whiteboard. So we go from DAS T minus 1. So that's kind of last period. And then that corresponds to a aggregate supply in time period T. So that's the time period of the adverse supply shock. So you can see that aggregate supply has declined considerably, right? We've shifted from DAS T minus 1 all the way to DAS at time period T. This is the adverse supply shock. And so at time period T, if we look at the state of the economy, we can see that we get YT and we get pi T. You'll notice that pi T, that's a lot of inflation, right? So inflation prior to the adverse supply shock was pi T minus 1. So inflation has, in a sense, soared. And of course, we can see that output is lower. We go from point A to point B, and so we take a pretty big hit in terms of output in the economy. Now, here's the thing, of course, that happens here is that because of this adverse supply shift, we're going to think about what the response is going to be ultimately from the Federal Reserve and everything. So let's take it through here, right? So higher shock, so the shock at time period T puts downward pressure on aggregate supply. We get lower output and higher inflation. But notice that, by the way, that higher inflation, we're going to see how that works out in just a second. But we get lower potential output, right? Well, that lower potential output is going to cause the aggregate supply curve, in a sense, to shift, right, and to shift back. And so the idea here is that at time period T plus 1, the shock has come back to zero, right? But we have continued high inflation. So the combination of the end of the shock, but the continued higher expectation causes the supply curve to shift in a positive way, but to only shift kind of a little bit. So there's only kind of a little bit of a shift in a positive dynamic aggregate supply because there continues to be higher inflation expectations. However, of course, that dynamic aggregate supply shift is going to cause inflation expectations to start to decline. And then if we move on to time period T plus 2, the reason why we have to move into time period T plus 2 is because we've changed those inflation expectations. And so, for example, so we go from time period T minus 1 to time period T, and then from time period T to time period T plus 1, and we get higher inflation expectations in time period T plus 1. But then because of that dynamic aggregate supply shifting downwards due to lowered inflation expectations over time, that's where we get that higher potential output.